Welcome to Adding Dollars. In this video, I'll be going over how much you could have made if you used the wheel strategy on TQQQ. I'll be testing this over different time periods and showing you the backtest results. Before I jump into it, if you're new to the wheel strategy or covered calls and cash secured puts, then make sure to pause the video and check out the videos in the description. Let's go ahead and jump into it. I'll quickly start by describing the wheel strategy, and then we can look at the specific wheel strategy that I'll be running in my backtest. So the way the wheel strategy starts is you start by selling a cash secured put, and then if you get assigned on that position, which basically means the stock ends up closing below the strike price of your put at expiration, you end up having to buy 100 shares of the stock for each option contract that you're selling. So in this example, let's pretend we're selling one put option contract. If we got assigned, we would be obligated to buy 100 shares of the stock at the strike price of the put. So if we get assigned, we now own 100 shares of the stock, and then we would start selling covered calls. So we would sell a call option at a price higher than the shares that we own. And what could happen in this scenario is if the stock price ends up closing higher than the call option that we're selling at expiration, then you end up getting assigned and have to sell your 100 shares of the stock. And then as you can see here, the process would just loop back and start over again. The alternative path is when you sell this cash secured put, the stock price might not come down below the strike price of the put option that you're selling, in which case you're not assigned, which means your cash secured put expires. You just get to keep the premium from selling the put option and then repeat the process. Let's say you do that a couple times, you then end up getting assigned because the stock price does come down low enough. You end up buying 100 shares of the stock, and now you can start doing the call portion of it. If you sell a call, but you don't get assigned, which means the stock doesn't end up closing above the call option strike price at expiration, then your call option just expires, you get to keep the premium, and you just repeat selling calls until this other path happens. Eventually, if you do get assigned and have to sell your 100 shares, again, you start the process over again, and that's why they call it the wheel strategy. Now let's go ahead and look at the specific wheel strategy we'll be doing for these backtests. This is exactly the same diagram as the wheel strategy with just a couple more specifics around the strategy. So in this case, we'll be selling a cash secured put that has a delta of less than or equal to 0.2. You can think of delta as the probability that that option ends up in the money. So in this case, we're only going to be selling options that have a less than 20% chance of ending up in the money, or you can think of that as less than a 20% chance of getting assigned. So you may end up just selling put options for a while because there's only a 20% chance you end up getting assigned. And then once we do get assigned, we'll sell calls that have a 20% chance of getting assigned. So again, you may end up just selling calls, collecting premium until eventually the stock does rise and you get assigned, have to sell your shares, and then repeat the process. Additionally, I'll only be selling options with weekly expirations, so expiring the following Friday. And then I'll also be doing these backtests with only one option at a time. I'm not going to be selling multiple options. If you're interested in seeing backtests with different delta values, different expirations, or a different number of contracts, feel free to leave those down in the comments and I can share the results. Now that we know the strategy we're backtesting, here are the results. I've written some code using the Quant Connect platform to backtest the strategy, and this screen shows all of the results. So this is a backtest starting from January 1st of 2023 up to September 15th of 2023. The main numbers to focus on here are the equity in the top left corner, the net profit, and the return percentage. Basically, if you started with $5,000 on January 1st, 2023 and ran the wheel strategy according to what I explained on the previous slide, you would have ended with $5,642.50 in total equity. So that would be a profit of approximately $642.50, or a return percentage of approximately 12.85%. And an interesting thing to look at in this backtest is that your max drawdown during that time period would have been approximately 9.65%. I also like to compare these results of the wheel strategy against the buy and hold strategy. So if you would have bought TQQQ on January 1st, 2023 and held it until September 15th, what would your return be? In this case, the results would have been approximately 135% return. It's hard to compare this against the wheel strategy because with the wheel strategy, you would have money coming in every week in terms of the premium that you collect, whereas the buy and hold strategy, you would still be holding the stock. Also, with the buy and hold strategy, you might not have bought at this exact low point. And if you look at this versus the wheel strategy on different time periods, you may end up with very different results. I also like to compare against the SPY with the buy and hold strategy. And in this case, if you would have bought the SPY at the beginning of the year and held until September 15th, you would have a 16% return, whereas again, the wheel strategy is approximately 12.85% return. If you want to see me run this same analysis on different time periods or different stocks, feel free to leave some suggestions down below in the comments. And as always, if you enjoyed this video, don't forget to like and subscribe so you can stay up to date on all of my videos, and I'll see you all in the next one.